Jason, how are you?
G'day, Rog. I am good. Good to be back on for another show.
It is, and obviously we talked about the Panthers last week. Are you a happy man now that New South Wales have got the NRL Cup and Victoria's got the AFL Cup? So
how about that? Look. Always disappointing for our Queensland friends, but you won't turn down a win. It was. I thought it was all over at half time. I almost turned the telly off, and then a couple of quick tries, and Jesus, all back on. So yeah, look, fun and games as always with the grand finals. It's it's nice to get a smile. Sometimes you get the state of origin result, and for New South Wales, not so much smiling then. So nice to get a result this time round.
Yeah, unfortunately, Queensland walk away with nothing. Poor guys. But anyway, welcome everyone to our Selfwealth live technical analysis edition. Obviously, we were just quickly had to chat about the grand finals, the big weekend here, and I'm glad everyone's here and able to attend. This week, we're going to talk a little bit about breakouts, channels, and trend lines. So I'm really looking forward to deep diving into this topic a little bit here. But before we move on, Jason, did you want to talk about your disclaimers?
Yep, let's quickly jump over to that. And just to remind everyone, as always, everything we talk about today is general advice. So nothing personal in nature, nothing tailored to you. It's all general in nature. And also another important point is that I'm not part of Selfwealth. I operate my own business called Motion Trader. I operate under a license provided by Chartreuse Wealth Management, and you can see all the details for that in that disclaimer below. So have a look at that. Important to remember. And with that said, let's get back to the more interesting stuff.
All right, fantastic. Now, I don't know about you, Jason, but I do love a good breakout of any sort. So can you explain to us what is a breakout and how can we profit from them?
Well, a breakout is a really interesting thing when you're looking at a chart and you're considering technical analysis. What a breakout is all about, it's about where an asset price, we'll say a stock, it could be an index or it could be a commodity, but whatever it may be, moves beyond a support or a resistance level. And when that happens, that's what we call a breakout. And and breakouts are significant because what they do is they can signal the potential start of a new trend, either a bullish trend or bearish trend, depending on the direction of the breakout. But it's our signal that a market is starting to move beyond the day-to-day or maybe week-to-week noise of market, which is just trundling along in a sideways manner. And I think that waiting for breakouts is a really important thing to do, and an important skill to learn. Like waiting is actually a skill. It can be part of a good trading plan. And what we're doing is we're waiting for the price action to tell us when it's time to do something. It's really interesting when you consider like how value investing works. So there are a lot of really good value investors out there, and they'll look for maybe a stock where its intrinsic value is below what the market's currently pricing at. But the problem a lot of value investors have is that a stock may appear like a good bargain, may appear a bargain, but the market may not be ready to take that price higher. And we can use breakouts to try and finesse that timing. So the famed value investor, a guy called Jeremy Grantham, he's one of my favorite value investors, and he coined the phrase. He called it the curse of the value investor, and that is being too early. It's being too early to a great idea. So what we can do, if you like value investing or even growth investing, or whatever type of way you like to break down a balance sheet, it's like you might see the idea there, but it might take a while for everyone else to see it. So what you can do is you can watch those stocks. You can look where a breakout level could be, where it would clear some resistance, and that could become the trigger to buy. So it could keep you out of a stock for a year or two, and that could be a good thing if it's not going anywhere, if it's still pushing maybe downwards. So knowing these breakouts is a really good thing. And I'll go through some examples. I'll show you some examples of some recent breakouts where there's been opportunity, which could have been gained had you been following these charts and where are the levels. So let me just get my my screen up. So I'm going to start with this example here. This is a stock index. This is the Japanese Nikkei, and it's an interesting one because I was talking about this on my weekly market strategy videos that I do back in around April. So what we have in the Nikkei, and it's also an interesting one because you can trade it through ETFs. There's ETFs listed on the ASX which allow you to get exposure to this. I'll just mention that in a moment. So here's the Nikkei. So from March 2022, it entered a big sideways range, and you can see like it had a big rally, started to pull back, and then went into a sideways trading range. And when we get into a range, we can identify our support resistance. That's what we spoke about last week. So we ended up with a support level beneath the market and this resistance band above the market. So whilst it's within this range, if you're taking if you're a short-term swing trader, well, you can try and trade these swings. But if you're more of a medium-term active investor, you may not be looking to that. You're looking to gain these large upswings. That's what I do. That's what trend following is all about, identifying these trends and riding trends. And so the interesting time comes when, firstly, the moving averages cross. We talk about moving averages a little bit more another day, but the moving averages cross, so it starts getting further up the watch list of stocks or opportunities you might be looking at. But the trigger point comes when we get the breakout, because you find lots of times where moving averages may cross, but price doesn't go anywhere. It just rallies for a bit and then falls back upon itself. So what we're looking for a combination of a moving average cross and then a break above some sort of a resistance point. So in this case, you can see this big blue band of resistance on the Nikkei. So here's the breakout. The breakout happened in May, and this is something which I actually spoke about at the time. So it's not just hindsight chart gazing where you see the ideas after they've happened. This was a real-time thing. So that is a breakout. And you go, well, look, how do you play something like that? And this is what I said at the time to people watching my videos. It was this BetaShares Japan ETF. So you can trade that, of course, on the Selfwealth platform. And you can see the same resistance point. So let me just draw in a resistance point on this chart. You can see some, see a band through here. So it came in at around $14.70. That was the breakout. So using a breakout as a confirmation to a potential trend change with the moving averages, and then going with the break above some sort of structural resistance point can be a good way to improve the odds. It doesn't guarantee you're going to make money, because these things can also just fall back upon themselves sometimes. And often, really, I probably should say, they can fall back upon themselves, but we can manage risk around that. We'll talk about that a little bit more later on. The point is that we're going with the momentum, and the momentum becomes a path of least resistance. A more recent example is uranium. And again, these are ideas you can trade via the ASX. Can't trade this particular one, but you can trade a uranium stock ETF. But this is the actual uranium price by a Canadian listed ETF. But it just shows that same idea of an asset which is in a range. We have various moving average crossovers, and the trigger point is when we break above a resistance band, and this resistance was this blue line, blue shaded area you can see above this previous price action. We got a breakout in August, and this is where I say sometimes you get breakouts that fall back upon themselves. We saw that breakout. It did initially start to fall back. This is where you got to think about where your stop loss placement is going to be. If you have it too close, you can get yourself stopped out. But then it finds support just above the 50-day moving average, starts to run again, and so we now get this confirmed breakout. And this has been quite a good run. So you could have been quite frustrated trying to play uranium for much of the previous 12 months, but by being patient, waiting for the breakout, you improve your odds of getting on something which is going to run. Now we can also take this to a stock level. So let's have a quick look at a couple of ASX stocks where I've seen some recent breakouts. Not so many ASX stocks breaking out at the moment, given the conditions that we're seeing in the ASX 200 and the All Ordinaries. So at the moment, we're seeing more breakdowns than breakups. But nonetheless, it's a market of 2,000 odd stocks, and there's usually something which is doing something interesting. So this is a stock called the Reject Shop. A lot of people probably know that by walking through their local Westfield. And what we had here, another interesting situation where we get those moving averages crossing back in April, but it's still within the bounds of this. You can see this green trend line above the market and this blue support beneath. It's still within the bounds of a trading range. So again, using a breakout to tell us when the momentum is really starting to shift. So the moving averages have turned, so we're watching it closely, but we want to see that upward momentum confirmed with a break above resistance. And that's what we got a few months ago in late July. Another interesting thing you can do is you can put on a volume study, because volume can also give you some good clues to the strength of a breakout. So you can see I've got volume down here. I'm going to expand this out a little bit. And what we see on the day that the price broke out, these 3 days, just looking at these 3 days around the breakout point, you can see there's a big increase in volume. So that's a good sign that the supply that had been coming on the market around the overhead resistance had been absorbed, and that there was a lot of buying interest to really start to push the market higher. So they're interesting things to keep an eye on when you're looking for a breakout and you're looking for volume. It's not always, it doesn't always collaborate the story. Sometimes you get a breakout, but the volume isn't clear cut. And this is the thing with trading. Not everything's black and white. And this a lot of people can find that hard to deal with, that it's not black and white. But it's a case of looking for clues, putting clues together. And just one last example, this is a recent one, Regis Healthcare, ticker code REG. So I'll just compress this. Let's have a little bit more of the history. So this is one of those support resistance bands we spoke about last week. And of course, you can get that on the Selfwealth YouTube site if you want to see last week's video if you haven't seen it yet. So this was on the way down, it's support. So the market's finding support. Once the market breaks below, it becomes resistance. And so this is around $2.40, $2.50. On the way up comes resistance. You can see several times Regis Health tests that region, and starts becoming interesting a few months ago in that we start seeing this series of higher lows developing on the chart just beneath the resistance point. And we've got those positive moving averages, and then we get the breakout. We get the breakout above resistance. And it's interesting just to look at this. So it breaks out and then it moves sideways in a tight compression band. That's a good sign when you see a market holding a breakout. Tight compression, that means that you got buyers coming in wanting to buy just above the previous break, and then once that supply is absorbed, we get another break. And so this is a potential stock which could continue to rally. It's holding up well despite the recent volatility in the ASX 200. It'll be interesting to see how this trades over the next few weeks. Will this breakout be able to sustain itself given the conditions in the overall market? So look, there are a few examples of what breakouts are and how we can potentially use them to identify stocks of interest.
Yeah, that's really good, Jason. A couple of things that I just out of all that was, number one, obviously, you were analysing a few indexes there, and you just always got to remember that there's generally on the ASX a product that will track an index. So even though you can't trade the index directly, there'll be some ETF that will track it. One of the indexes around the world. I'm pretty sure you showed the Japanese one there. I know there's one that does the Indian stock market because we got asked about it. So you can always do a general search and you'll find an ETF that tracks or uranium or oil or something that tracks the indexes, right? So that's really good that you brought that up. Number two, the volume indicator. That was I never sort of put those two and two together really. I never really used volume, but is there an example of that on those couple of breakout charts with the ASX shares that you just showed then? Did they have high volume on those breakouts?
On On the one which I showed, the one for the
just the
reject shop,
Regis one.
the breakout was really followed with that high volume. On Regis, not so much so. So I'll show you what happens with Regis on the volume. And this is why I say it's not always, the volume doesn't always back up the story. It doesn't mean the story's not there, just means it's not as clear as when you get that strong volume. So just looking at this, so we did have a high volume day as the shares pushed up into the resistance zone. Then you can see the volumes backed off as we've look, the volume is actually still elevated compared to where it had been in previous weeks. So the volume is heightened around this breakout point. And then as it breaks up again, it's like there's not so much of a story as it breaks up again. That doesn't mean that it's not worth following. It just means we don't have that extra support. I like seeing when you've got that strong volume following breakouts. Tends to also happen in larger, more liquid stocks. Not always as evident with as you come down through some of the smaller caps. Sometimes it is, sometimes it's not. As I say, it's just not always black or white. So I wouldn't say, oh well, look, this breakout's not accompanied by high volume, I'm not going to pay attention to it. I think it definitely is worth paying attention to, but it's just one of those extra things to be aware of, and it can give you that extra confidence, or sometimes it doesn't tell you a great deal at all.
All right, okay, fair enough. While we're on the examples, the XAO, I think that's the ASX 200 or the All Ordinaries, one of those.
All Ordinaries, the XAO.
Do you want to? It's saying we've got journey and destination, looking to be breaking to the downside. Do you agree?
Yeah. It very much it's a good example of a current break. So let's go and have a look at. I'll call up a chart of. Let me just switch around my indicator group, and I'll have a look at a chart of the ASX 200 because I've got some lines already drawn on it. And this is a chart. I think we actually spoke about this last week with support and resistance. So we had a support in the ASX 200, and you can see some quite clear levels which had where demand had come in to support the index. We had the breakdown a couple of weeks ago, and then the market had just been sitting beneath the previous support, which then becomes resistance. Hadn't been able to get back above it, but hadn't brought the follow-through selling either. But in the last couple of days, we have had that follow-through selling. So it's market's always at its most vulnerable when it's sitting below resistance and below declining moving averages. So, and this is what I've been saying over the last few weeks. It's like, we don't want to argue with a market which is sitting below declining moving averages, below overhead resistance. It's like you got to consider, is the path of least resistance changing to the downside? So this is where I say we can use breakouts to indicate where momentum might be starting to shift, and so far this has been the case in the ASX 200, and also in the All Ordinaries. Just clicking over to that, and it's look, you can see it's continued to roll over after these moving averages have crossed. So yeah, it's those breakouts can be helpful for telling us when we're moving out of a range-bound period and into a potential trending period.
I'm really glad we're able to sort of educate people on this sort of stuff, because I wonder if people knew, like general everyday investors knew about these ways of seeing how the overall market, if they'd still be investing in certain stocks, right? If they knew that the market was on the way down, right? So,
there are down days and there are down days. It's like, a down day a couple of months ago, the market was just trading within a range, and so it's not so much to be concerned about. Getting a down day now after the market's broken to the downside of a range, well, then that is more concerning. And it's a case of looking at your portfolio and going, look, do I have stocks in there which are continuing to weaken, which maybe I should now exit, because I'm now concerned about, like, how far could they fall? And we don't know. the market could bottom today and then rebound. So this doesn't mean the market's going to continue to fall away. It just could be continued weakness within a broader corrective period. So it's not a sell everything moment necessarily when you see a market like the ASX break that level we were just looking at it. But it's a point where you say, okay, I now want to be very selective on what stocks I buy. I want to maybe tighten up my portfolio. Maybe I want to get out of some stocks which have been starting to struggle. And that's what I've been doing over the last couple of weeks. I've just been exiting a few things which have been giving ground and hitting their stop losses. It's like I don't want to. I think holding and hoping is a dangerous game when markets are declining and they're breaking supports. It's we've got to protect capital. If we're going to stay in the game, we've got to protect our capital. And breaks to the downside, they're just they're a flag to say, look at your portfolio, make sure it's all nailed down and you're comfortable with how things are positioned. Break to the upside, it's a different scenario. It's like, okay, let your profits run. Let's see where this break takes us. Whereas some people get a breakout to the upside and they go, oh, good, I'm going to take some profit. I've made some money. So there's different ways. You've got to have your ideas around what you do on either break. Break to the upside is a good thing. Let things run. Break to the downside is a warning. Be careful. Think about exiting things which aren't working.
Yeah, and I think that's the first thing I learned from my trader education is protecting your capital. So it's always a good lesson to have. Let's have a look at another couple of examples while they're here, if that's all right, Jason. BOE, another good example. BOE.
BOE, so Boss Energy. So it's a uranium play. So let me just get my chart back and call this up. So BOE is one which has broken out of ranges a while ago. It's been a really good play. So I've actually already got a range already drawn up in here because it's one of the stocks I speak about sometimes in my weekly strategy videos. And we had the breakout back in June, and it's also one of those breakouts where we've got some nice clear resistance points from these previous highs. And it's one of those ones where, again, it's not clear cut because the market edges through there, trades around the top of that band, then it just starts to dip below. It doesn't dip too far. It's held by the moving averages. So as I've said a couple of times today, it's not always black and white. You've got to combine sometimes various indicators together, and you're putting puzzle pieces together. So it had started to slip, but it was holding the moving averages, and then we do get the clear breakout to the upside. And this is you can actually also draw I'll do some other lines on this chart which are interesting. You can get within the trading range, there's a secondary trading range that goes on. This just might be interesting to people who are interested in charts. So you can see we've got the main range, then we get a range within the range, we get a breakout from that. You can see there's a little tight compression band there. We get a breakout. So breakouts are our sign that things are happening. So when we're compressing, not much is happening. When we break above the compression band, we start getting momentum. So we get momentum. And then you can also draw in another trading band just through there. It's a bit of a trend channel, a short-term trend channel. And I think we're going to talk about trend channels in a moment. And you can see this short-term trend channel where it bounces back and forth, and then we get another breakout. Just for interest, let's put the volume on and see what we get. I don't know what we're going to get, so let's see how it comes together. And yeah, look, you can see there's elevated volume as we break out of that first range. There's elevated volume as we break out of that second band. This is actually shaping up as a great example. Elevated volume as we break out of that next one. So and as it was just starting to slip back down, just try and get the scale right so we can see things nicely. As it was just dipping back down, there wasn't a whole lot of volume, and it was coming to those moving averages. So there you might say, well, look, I'm not we've got a breakout. It's not holding at the moment, but it's not giving way to, it's kind of holding its ground, although slipping slightly. Volume's not picking up. It's above the moving averages. So in terms of like where you place your stop loss, I'd always suggest that these sort of things, give it a little bit of room to move. Don't just jam your stop loss right below the closest point, unless you're a short-term swing trader, of course, then you may do that. But if you're trying to capture these larger moves, you've got to give them a bit of play, bit of wriggle room. And if you've done that in Boss Energy, well, that's been a really nice trade. It's now a case for me, as a trend follower, it's a case of let that profit run. Let's see how far this can go. Use a nice wide trailing stop to see off the inevitable pullbacks you're going to get along the way.
Yeah, and that's a great example, I think, for sure. It's a good example of seeing all those different indicators converging to give you that picture of, all right, yep, now's the time to get in, right? So what about this example here, VHT? Can we have a look at VHT?
VHT, yeah, let's call that up. So that would be Volpara Health. So this is one. This was a motion trader signal not that long ago, in that we got a breakout. Like, we've got positive moving averages. They came in June, and so looking like where could a breakout point be, and like you could use these previous highs as a potential breakout point. So we had a compression. You can see how the price compresses. We get a rally, then it compresses within a band. We get a breakout. So that's all looking good. This is looking like a promising trade. It does initially rally, and then it just falls back in on itself and rallies, but can't really get past the moving averages, starts to fall again. So for me, this becomes a stock which look, if I bought on the breakout and I'm using a wide trailing stop, it could still be a stock which I hold on to if I'm holding a medium term orientated portfolio. But it's one which I've got a red flag against now, because moving averages have crossed to the downside and the price is now starting to consolidate below those moving averages. So I start to think, well, now is this setting up to actually break lower? At the moment, we call that a false break. Doesn't mean it's going to continue to fail, but the initial momentum that we got hasn't followed through. So now it's a case of how do you manage a position? It could well be cut. A position could be cut, or it could be given a little bit more room to move if you want to try and stay on what could be a broader recovery. But in terms of entering a position now, well, no, it's not one you'd look to enter, because you don't have that upward momentum to enter this position now. You'd need another break to the top side. We could be using. I'm just looking at things as I'm talking. Like, there could be resistance up around 84 cents, maybe back above the moving averages, back above 84. You start saying, well, look, is it starting to turn to the upside again? But at the moment, yeah, it's not a place to look for a new position.
Yeah, I think I had that one on the July from your service, Jason. I think I removed it. Like you said, as soon as the price drops below the moving averages and below the previous sort of peak or break, I just remove it off my watch list. And there's plenty of opportunities, right? Move on.
There is. Well, I had that one myself. I had that one in my portfolio, and I sold it, I think, a couple of weeks ago, because I use a time exit as well. I don't always wait for my stop loss to hit. If a stock isn't performing after, for me, it's about 3 months. I use 60 trading days as my. 60 is not a magic number. It's just what I use. If a stock isn't in profit after 60 days, I'll move it on. I'll take the capital and I'll look to put it into something else. Or in the current conditions, I might just let it sit in cash for a while. There are various exit strategies. I think we spoke about exit strategies a few weeks ago to how to handle these situations.
Exactly. And this is where there is method to the madness of how we've done these sessions, right? We're trying to build on top of what we've learned previously. So if you've missed any of the sessions around exiting, then please go back in It'd be around weeks 4 or 5 that we were talking about exit strategies, right? So just remember, anything that we speak about, anything that we talk about ourselves, it's none of it's personal advice. It's all just general in nature and education. In the meantime, if you want to write a comment on the video or like and subscribe, then we'd appreciate that as well, because it keeps us going, right? So, all right, Jason, now that we've talked a little bit about it, can you show us how to draw price channels and how they're good for trading breakouts?
Yeah, price channels are an interesting one. So I'll and it's interesting with stocks because you don't see that many really good price channels develop on the charts. I tend to see them more in currencies. You can see them in shorter term charts sometimes. Not always that many great stock examples. But let's go through a few examples of what a price channel is. So I'm just going to change back to a different watch list, and let's have a look at the Nasdaq, because this provided us with this was one of the great trend channels. What I'm about to show you. So it's not in the current period. It just goes back a year or two. And it was during it was the great bull market from the COVID lows. There's the COVID low in March 2020. Then we went on this great advance. And what I do, I look at, like, you got to step back. You got to look at the price action, and it's you're looking for where you might be able to draw a line along for an upward move. Anyway, you're looking for a line that might fit a series of low points. And when I look at that, this low catches my eye because it seems to line up generally with some other ones. So I'll draw that along, and then once you get that, you can then project it higher, and I can just play around with this a little bit more just to get the best possible fit. And this is something I did in real time. This isn't a hindsight channel. This is a real channel which provide real clues to what the market was doing. And so this is a really good channel. So what makes a good channel is lots of touch points. So a touch point is where the market comes back and touches the line. So of course, where I'm looking now in November 2020, the channel didn't exist. This channel you can only start looking at this channel possibly after this second point in March 21. So until then, there's nothing to look at. But we get a couple of points. And so you could have linked those 2 points and projected up to the next high, but it's nothing I'd be getting too excited about at this point. Wait a little bit longer, we come back, we get another touch point. So now we've got 3 touch points. So even if you're just using this without the top line, you could at this point be drawing a trend line and going, okay, that's an interesting point. The market's coming back, touching and rallying again. Then it does again in October 21. So now this is really getting like this is a really good trend line because you've got so many touch points below. Rallies back up, and it gets back to this upper line now, which it had seen on like these previous occasions. So, and this is where the market starts to stall, starts to pull back. Again, it's not a problem because within the channel, it does this. It gets back to the base, rallies again. But this is again on my weekly strategy videos. I brought this to the attention of people watching. I said, hey, look, this is now broken out of this long established trend channel. This is a weak point in the market. The moving averages are also rolling over, prices below the average. So we've got a few things going on. It's not just one thing. We've got a few things that we're leveraging off to get a view. So the market was at a vulnerable point. So as I was saying with the All Ords just recently, it was like a case of, well, let's just tighten up the portfolio. Let's get rid of things which are slipping, which are hitting stop losses. Let's be careful about what we're buying, and you can see what happens after this trend channel breaks. The market falls away. Of course, there are rebounds, but you can see it's a general change in the trend. I'll show you another example, but from a downward perspective. This is a chart of Microsoft. So this is a recent example as well. So COVID lows, big rally, and then this is the last year's volatility, last year's correction. And just by looking at this, I can see there's a general pattern to the decline. And what you can do, you start looking, you just get the lines out and you start drawing them. Sometimes your eye doesn't quite pick it and it doesn't quite work. Other times it does. So let's just draw something in, and I'll do the bottom one in a moment. I just want to see if we can line up on the top. So it's kind of lines up fairly well along the top, and then you can project it down to the bottom, and you collect. So at the top we've got 3 high points, and then at the bottom you can see numerous times the market's come down to around this level and rallied. And the interesting time for me for this, it's when we break to the top side. That's what I'm looking for. I'm looking for a break out of the channel. So market starts to break out of the channel. Shortly after the moving averages cross, we get what we call a return move, where it pulls back towards the breakout point, and then we get the secondary breakout as in March, as the market starts to move above the previous peak. So we've got 3 things on the go here. We've got the moving averages, we've got the initial breakout, and we've got the break to a new high. So it tells us that one of the largest stocks in the market is now starting to trend upwards, and then you combine that with what the S&P 500 might be doing, what the Nasdaq might be doing, and you start to develop an outlook on what the overall market may be up to. Also interesting around, like, the market bottomed in October, and you look at where Microsoft was in October. It was down the lower end of this trend channel. It's not to say that a channel can't really accelerate to the downside, break beneath the lower end. Does happen sometime, and you get this waterfall decline. But it's also another suggestion that maybe the market will find support around here, which is what actually did occur. We can look at some other things which are interesting. I'll look at here's one which is interesting. This is the Aussie 10-year bond yield. And I've got some other stuff drawn on there, which I've talked about in my strategy videos, but that's not what I want to talk about here. Let me put this on a weekly chart and compress this. So this goes back. So channels can appear in 15-minute charts, hourly charts, daily charts. This is a weekly chart. So this goes back to 2008. And a look at the touch points on this. We've got 3 clear points. Actually, we've got 4 clear points on the upside. We've got a couple on the downside. And again, this is something I spoke about at the time. So not a hindsight channel. It's a real active channel, which was helpful in pinpointing a big shift in the market dynamic for yields. And you can see we got this breakout in late 2021. Got the classic return move, which I just showed you on that previous chart on Microsoft, where we got the return move. So you got the breakout, the return move, the moving averages have crossed, market starts to increase. So the yield was going up. So this big increase in yield we have, and this was early on in the piece. This is when yields were still back at below 2%, back around 1.5%. It's now we're up up at 4.5%. So it signals a significant shift in the momentum of the market. And you can see the same sort of thing in the US market when you call up. We'll actually go through it. Let's actually just construct a channel, because I don't have it drawn up on this one. So looking at this, and it's also interesting because it goes back further. This one's going back to we're going back to past 1987, back into the early 80s for this. So this is just something else I've been talking about in my strategy videos. You can see there's a big resistance band there, which is interesting because the market is closely coming in close to 5% now, which I think yields are going to find resistance to going higher. Maybe we get some sort of pullback. That's another story though. At the moment, we're on about channels. So where's the channel here? And this is where sometimes you've got to play around with it to find something which is going to work. And I'll show you why I say that. So I look at this and I can see there's something going on around there. So let's try and draw something up. So I'm going to start at a high point, and I draw a line down, and I do that, and you can see it doesn't quite work. Go, oh, this isn't really working. But let's stick with it and let's see what we can get. So I'm going to do a double line this time, because it's such a long-term trend line. Sometimes it just doesn't quite work, and you got to. But when you give it a little bit of more study, you find that it actually does come together. And you can, when I line all this up, you can see with the double line, what wasn't working actually now becomes something which brings in a whole lot of touch points over. What's that? That's a 35-year period, so it's a long time. Now let's see whether that follows through on the downside. Just going to copy that. Let's just compress this, make it one line this time, and let's bring it down. And lo and behold, there's your trend channel. Get all these touch points on the downside. So this is something really interesting to be aware of when you're looking at markets and looking at, like, the bigger picture. This isn't about what's going to happen tomorrow or next week. This is bigger picture stuff when you're looking at weekly charts. And then we can blow that out. And again, something which I spoke about at the time. So this was April in 2022. We got a breakout from this big weekly downward trend channel in yields. And well, we can see what's happened in yields in the meantime. Since then, they've continued to rise. Now, want to finish up with one more channel, and now I'm going to talk about, like, it all looks so simple when you do this, and people see this and they start drawing channels and everywhere. They start seeing things that really don't exist. So let's go to, just going to quickly jump over to NAB. Let's go to NAB. I'm going to put it back onto a daily chart. I'll tell you what, I'll show you a mistake which I often see people make. So they'll call up a chart, and they'll call up a chart like this and go, okay, well, all I've got to do is link up some lows. So I'm going to use this low from March 2020, and there's another low. So this is what someone might do if they're looking at this graph in real time, this chart in real time, and there's another low. So let's do that, and then we just project it up, and look, now we've got a trend channel, and look, it's working. The market's broken down. This is a great trend channel, but it's actually not a great trend channel at all, because what you're really doing here, you're just kind of linking up two points which don't really have much to do with one another. There's no secondary points. All your touch points on the top occur before we have this second lower touch, so it's not usable. We don't know this until we get this second low point. We can't even draw a line at the top. So these touches are, you don't know they even happen at the time. It's only when this low is made that you can see in hindsight that we had touches there. So that's not particularly helpful. Then we get a break, but really we already had moving averages crossing. We had a break below support. I think that was more important than just breaking below a random line. We could have used, instead of that point, we could have used that point or that point or that point at the time. They would have been meaningless. So it's about, the big thing with these trend channels and technical analysis generally is that you've got to be careful that you're not constructing things in hindsight which wouldn't have been useful in real time. And with the channel, the bottom should really relate to the top, and you need to get those touch points. Otherwise, you're really just looking at a mirage, which isn't going to be particularly helpful in putting anything together.
Yeah, I love actually some of the earlier examples you put up. I love the fact that when you do a channel and it breaks out, that one of those lines generally coincides with the crossing over of the EMA. You literally draw a trend line straight through the crossing of the EMAs. So it just adds another sort of factor to a trade, right? If they're both there, right?
Yeah, we're always looking for confirmation. Yeah. It's not just one thing. Not one thing. There's not one special rule which is always going to work. It's looking for confirmation, looking around you and looking for other things. It could be another stock, it could be an industry, it could be something else, could be something a currency is doing, whatever it may be. You're looking for things that you can pull together, different indicators. You don't want 1,000 indicators on the go. You'd be continually confused by too much going on. But just a few simple things: moving average, a confirmation breakout. It could be another supporting factor, and then you've got a potential opportunity. You manage the risk around that opportunity, and that's how you can make money when things work. And when it doesn't work, you use your risk management, and you just reverse yourself out and hopefully don't do too much damage.
Yeah, exactly. What strategies can be used with these price channels then, Jason? What strategies are we looking at?
Yeah, so we'll go. Let's just quickly go back to that Nasdaq chart, because the Nasdaq one is a really good one for just providing the example, like how you might use one of these patterns. And so the idea with a trend channel, and as I say, you define a good trend channel like this in an ASX stock. I don't see that many of them. But when you do, they can be useful. So what you're doing once it's established, and as I said when we're looking at this one really doesn't become established until we're well into it. So maybe from around this point here, when the market comes back, you could consider buying. Is this a buying opportunity? We've had a rally. We're returning to the moving averages. We're near the support from the lower boundary of the channel. This is an area where if you're going to buy the dip, this is where you might want to buy the dip. And then you work out your stop loss. The stop loss might be a little bit below the where would be the breakout point from the channel. You've got to give yourself a little bit of room, because you can get situations like we saw in January 22, where the market dips below, then goes back up. These things aren't perfect. They're not lines of precision. They're lines of general market direction. And so you can buy the dip, set a relatively close stop. If that overall trend continues, well, then you've gotten on what could be a good move for relatively low risk. Now, the opposite applies as the market's getting up towards the upper end of the range. So around this point in September 21, I would have really hesitated to look, do I want to really add to positions up here? Is this an asymmetric entry point to what may already be established positions? Maybe you've got positions from lower levels. Do you want to add? The time to add is probably either when prices are breaking out, like we can see here in August. You can see there's a general compression zone which builds in during that period. So you get a breakout. That's an asymmetric entry point. Doesn't mean it's going to continue to go in that direction and make money month after month, because then we go into a correction. But the closer we get to this upper boundary, the more you think, okay, this may not be an asymmetric time to get in. Maybe it's a case of holding what I have and being patient. Again, buy the dip, be cautious as we get up the top. If you bought the dip in January 22, well, it didn't work out, but sometimes it's not. Often it's not going to work out. That's why we have a stop loss. So it's not a case of it didn't, it's broken down, we're bought, we're going to hold and see what happens. You have your disciplined exit point. It hasn't worked. Let's cut it early and move on. Let's wait and see what then happens. Coming to current day, just go look at current day, like how we might use it, because we've got I've got a chart of the S&P 500, and this is interesting because it's actually an unfolding trend channel. So this isn't all just about looking at stuff which has happened in the past. It's about also looking at and applying it now. So who can see a trend channel in here? Let's draw it in. So here we've got our low point from October 22. We're going to use this low from March and just continue that along. And when we use that March low, you can see coincides with where we currently are. And you can put the top one in, and you can see we get two good touch points on the top. So that's the basis of a trend channel. So here we are now. Do we buy the dip? Is this a dip to buy? We have structural support coming in beneath the market at around 4,200, very important level. We have the channel. What's a little bit different to some of those early ones of the NASDAQ is that the S&P is now below these moving averages, which is starting to decline. So is this a warning that this isn't going to hold on this occasion? But we don't know. We don't know. Maybe it will. Maybe the market will be able to find support from the channel and the structural support just beneath the market. So if someone were to buy the dip, we have a clearly defined exit point, not too far from where prices currently are. If it does find support, if demand does come in, we do get a rally. Well, then we've got the potential of this market moving back up above the July high, back towards the December 21 high. That is a viable scenario. There's decent upside there with relatively low risk. Whether that's a situation, like, it's not a situation which I'm going to play at this point. I have exposure to the market, but I'm holding. I'm not adding. But that's just me. Some people want to buy the dip, and that's a viable strategy. And this is you can see this is set up as a potential opportunity where you have an asymmetric setup in that risk is relatively contained to possible upside. So look, that's a trend channel in real life, currently in play. It'll be interesting to see how this one does unfold.
Yeah, exactly. All right, let's go to a couple of questions here. Do you have suggestions for how to get in if the initial breakout is missed?
Markets always pause to consolidate. Look, there are different ways to do this, and I've been caught myself where I've missed an initial breakout because I've been focused on doing something else. I've got a breakout. I've looked back at my charts a couple of days later. I'm going, oh bugger! I should have been paying more attention. I missed it. What do I do now? And it can be hard sometimes. Sometimes a stock will pause soon after a break and consolidate, so you will get that second chance pretty easily. Other times it will go on a run and you're kind of left watching. It's a tricky one. Sometimes I'll just buy half a position at an elevated level because I just want to have some exposure in case it continues to run and run and run. Something like those uranium stocks we were looking at earlier, something like BOE, Boss Energy, I'd find it very difficult to buy had I missed that initial breakout, given it's run so far. It's run something like, top of my head, maybe 50% from the breakout point. I think now at this point, this advanced point, I'd have to wait for the market to consolidate and then look at a potential secondary or tertiary break later on. There's no particular signs to how you get in if you miss out. Sometimes you say, look, I've just missed it. I've let it go too far. The asymmetricness of the entry just doesn't stack up anymore. I'm buying it. It's too elevated. I've got to have too much risk to get on. It just doesn't stack up. I've got to leave it. It is a case-by-case situation, and it does vary from stock to stock.
Yeah, obviously you probably need to use a bit of discretion there. But I know with your service, Jason, I know it might signal, a few times there's been a breakout, right? So maybe that could be a strategy, right? So you may have missed the first breakout, it consolidates. Maybe you're looking for the next one, right? So
yeah, well, every big trend always has multiple entry points. There's not just one time to buy a stock, not one time to buy a breakout. It's just like the next breakout might be maybe a few months away. It might run, might consolidate for several months, might break again. So there's going to be, in a big trend, there'll be many potential entry points which are viable, and it's just waiting for them. So with Motion Trader, I provide up to 10 entry points for stocks for that very reason. Because if sometimes you don't have capital when you get a good breakout in a great opportunity. And then capital frees up and you want to look at that stock again, so you need a new entry point. So then you look at the charts or look at the signals I send out, and you can find those extra points when markets consolidate, go into compression bands, and then break again. That's my favorite way of getting back in. When they pull back to moving averages, they always come back to the moving average at some point. And if you want to buy a dip, you buy the dip when it comes back to the moving average and starts to push higher again. Look for the break higher off the moving average. That can be another good point to get in.
Yeah, I'm a big fan of the break and retest, and you had some great examples there, i.e. with Microsoft, where it just broke out of that on the way up. It broke out of that channel, come back and retested the EMAs, and then it went, right? So I wouldn't have got in on that first breakout. I would have waited for that retest and got a bit of confirmation on the way up, and that would have been a great reversal move, basically, which we'll go on. We'll talk about next week. Actually, we're going to talk a little bit about head and shoulder patterns and how to sort of try and pick up those reversal moves. And what about RMD? We've got RMD. Someone asked, Hassan's asked about RMD. What's your thoughts of that?
RMD. So let's have a look. Let's call up RMD. So ResMed. Yeah, so big. So it's interesting. You can see the compression pattern in there in the trend line. We get a few touch points on there, and you can see the overhead resistance on the chart. Probably. Of the last few days against what we're seeing in the broader market, but it need to do a whole lot more price action for me to get interested. I'm not looking at you can often get these big upward reactions from stocks which fall quickly. They can have these big upward reactions back towards the moving average. And if you're a short-term swing trader, you're looking at short-term moving averages. You can potentially get some of those moves, but they're a lot harder to get. They're for people who have the time and the skills to be looking at the screens a whole lot more than most people can do. If you're your typical medium-term active investor, capturing those upswings, I think they're you're more prone to get into something which then reverses and falls again. So I leave them alone. For me, this is a stock which I'd want to be out of. I'm not looking to buy. It'll take a while for this technical damage to be unwound, for the moving averages to stabilise, to turn higher again. ResMed could be on the outer for quite a few months.
Okay, fantastic. Now Kirby's asking, what warning signs do you look for that a breakout may be failing?
It'll be where a stock where we get a break to the upside and you just don't start to see that follow through momentum. Follow through momentum doesn't have to come from day one. It's okay if a stock just looks like it's stalled and travels sideways in a compression, because that can then be the stepping stone, the platform into the next leg higher. It's when it starts to dip back below the breakout point, maybe gets back below those moving averages. That's when you start saying, look, this is just not working. If volume starts to pick up on the downside potentially, so there are a couple of flags to look for. But first flag is falling back beneath the breakout point. It's not all over, definitely, because it might stabilise just beneath and rally again. Getting below the moving averages, that's a definite danger zone once you see that occur.
Yeah, fair enough. And any thoughts on PBH?
PBH, let's have a look. So
points bet.
Yeah,
had a massive gap down, to be honest, from last time I saw it.
Here we go. Is that I think that could be due to a restructure. I don't think that's a real price move. If I hit this adjust button, it might correct for that. Yeah, and it has. So if there's been a special dividend or a capital return, you can look like you've got that big gap lower on the chart, but it's not a real gap because no money's been lost. So you need to have data or a data provider that will make those adjustments. And But and looking at this, it's interesting when you look at this because this is a stock which has fallen from great heights. It's been a disaster. So anyone trying to buy the dip through this downtrending phase has really lost. Hasn't done well at all. You want to buy the dip when a stock is trading above the moving averages. When you buy dips, when you're below moving averages, it's when you sell rallies. You certainly don't buy those dips. But what we have now, we've got a situation where moving averages have crossed, and the price has, and we do have a breakout of sorts. You can just draw a short-term resistance above these previous highs. We're broken above there. We've had a return move. We rallied again. So it's a stock with potential and has fallen so far. Lots of stocks have turnarounds which have fallen a long way. Some don't. Some just go out the back door and ultimately get delisted. I don't know what's going to happen here, but it's got the potential for a trade where risk can be managed. If this breakout doesn't get followed through, well, you've got your stop loss where you just say, okay, it's not working, I'm getting out. But look, just returning to 2022 levels, that gives a lot of upside from current levels. So you'd say this is an asymmetric possibility. So maybe one to have a think about. The only problem is with it though, like we're in an environment where you've got the ASX 200 breaking down. So that's just it's a point to remember when you're looking at breakouts. Is the situation going to be strong enough to not to be overwhelmed by what's happening in the broader market? Sometimes it will be, a lot of times it won't. It might put a good breakout on hold, and it could take more time for that stock to be able to get going. Sometimes it takes a broader market stability for it to maybe go later on. I don't know what's going to happen with PointsBet. It's certainly one to, it's certainly a stock of interest. Rog, I've just lost my audio. So don't have you on the audio at the moment.
No, you haven't. That was my fault. I accidentally put my microphone on hold. And all I said was maybe you're a gambler and maybe you like the PointsBet Holdings stock. So maybe you just like that. Jason, thanks again for your time today. I think we always go over time from what we because we love talking about this sort of stuff. We appreciate everyone's time to hold on the line with us as well. It's been really good. Next week we're going to be talking about something else that builds off what we talked about this week in trend lines. Like I said, we're going to be talking about the first sort of price action pattern, I guess, which is like head and shoulder patterns, as a potential reversal to what to look at, in these price action patterns that might evolve. And then the week after that, we're going to be talking about top and bottoming patterns. So plenty of stuff to talk about as usual. But really appreciate it, Jason. Thanks again, Nate, and I hope you have a great week, and everyone else have a great week ahead as well.
Yeah, thanks, Rog. It's been good. Covered a bit of ground today. Hopefully some interesting things for everyone watching. And I look forward to catching up next time.
Cheers, guys. Thank you very much. Take care. Bye-bye.